Welcome to our Growth Investor Pro weekly webinar. It's Thursday, the 12th of February, just after 4:15 Eastern for the benefit of the tape. Okay, so today we got a lot to cover. I'm going to do a very, very quick run through the indices. So the S&P, the Nasdaq, the Dow, we'll look at bonds with TLT and look at the VIX. And then we've got a long list of single ticker, I should say, requests, which we'll deal with. And I want to highlight as well at the end, and this will come out as we go through these single tickets. But the theme I would like to sort of keep reiterating today is, remember sector rotation. Okay, nothing goes up forever, nothing goes down forever. What you've had in recent months is a big run up in metals, miners, industrials, staples, materials, all the value stuff. And I'm not saying that's going to roll over tomorrow, but I am saying that if you look at a lot of those charts, they're topping out. And if you look at a lot of the growth charts, they're bottoming out. And this comes at a time when you've got this hammering, inescapable narrative of AI is going to ruin everything digital. Everything's going to end. Everything's, and that kind of narrative is exactly what happens at the bottoms of sectors. So I'm not saying that tech doesn't have further to fall. Anything can happen. Microsoft could drop by 50% tomorrow. What I am saying is this has all the signs of a peak selling narrative where people want you to sell these names. So you'll see as we go through the individual stocks that my view on all these things is, number one, you have to protect your own capital, protect your own risk. Everyone's responsible for their own risk. You stop losses, hedges, allocation sizes, whatever it is that suits you. But do not for one moment think that it's all over forever, these stocks. And even if you get stopped out, even if you sell at a loss and you sit back, rotation only works. The creation of free money via rotation only works by large accounts buying at the bottom. And when you see this crushing narrative, that is a signal, usually, that things are reaching a selling frenzy. In 2022, as the bear market was ending, the only thing you could see anywhere was absolutely colossal recession coming, massive drops coming in the stock market. Of course, it didn't happen. And so, again, I'm not saying we're going to see a rip up in growth tomorrow. I suspect it might be Q2 before that happens. What I am saying is do not fall for the fear narrative. I'm saying stay cold, look at the charts, protect your own capital, but don't assume that anything is forever. Okay, with that, let's do our disclaimer and let's get going. So, disclaimers on your screen right now. So this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information analysis in the webinar is not an offer to sell or the solicitation of offer to buy any securities. Nothing in the webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Session Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in the stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Cestern Capital Research. Cestern Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, let's get some microphones switched on. As always, we run these things on a live and open mic basis. So if you have points, comments, questions, things you agree with, disagree with, any at all, open your mic, shout into the system. And if you can't or don't care to use audio, use the Q&A or the comments functionality here in the webinar platform. Right, let's go. Let's do the S&P. Let's do the boring stuff first. It's really important. It's a way to anchor understanding of where we are in the market. Right, here we have SPY on the monthly. What does this tell you? It tells you that we're in a continued uptrend. It tells you that February is kind of, so far, it's an inside month on January. So it's the high of February is no higher than the high of January, and the low of February is not really any lower than the low of January. So February so far is a nothing burger. If we look at the NASDAQ's telling a slightly different story, which is, look, the NASDAQ peaked in, October and double topped in November, again, January, and it's sort of rolled over. So the NASDAQ for the moment is in a downtrend. We can argue about how long that's going to run. I don't think that's permanent. I think it's going to find support. Maybe it takes till Q2 to do that. But the NASDAQ is weak. It's the weaker of all of the equity indices right now. Dow is very strong, as everyone knows now. It hit 50,000 yesterday on the index. And if you get these charts every day on our website, then you will see that the Dow just hit the lower level of this fifth wave termination zone. By the way, this is a bearish take. I'm not sure this is correct, but this was our sort of manage your risk type chart. So it's possible, it's just possible that the Dow hit a high yesterday and will sell off from here. I don't think that's the case, but this is just this is a bearish take on what might happen. So it's possible that that's a long-term high in the Dow. I don't think it is personally, but we can use that as a keep an eye on it. Let's zoom in a bit and let's look at the S&P shorter term. There we go. It's just chopping and going nowhere, right? That's what's going on shorter term. The reason that everything feels difficult at the moment is the market's flat. Look, it's been flat since October, pretty much at index level. So you had a little run down in November, but apart from that, it's you've got a variation of 676 to, let's call it 695. So $20, hardly any percent in the last 3 months. By the occasional sort of foray to the downside. Nasdaq, more volatility, but still basically flat. And the Dow, again, here you go. Now, what I think is possible is on this shorter term time frame, is the Dow hit a high on this short term run that started at the Liberation Day lows. Okay, so if you follow this on the Dow, the reason it's important to watch the Dow is often the Dow leads, then you don't trade it. So here's your Liberation Day lows: 1 up, 2 down, 61.8 retrace, 2.618 wave 3 extension, a shallow wave 4, just a 23.6 retrace, and now we're well into that typical wave 5 termination zone. It hit just above the 0.5 extension in there and rejected and sold off. Now, no chart analysis is perfect, but these wave 5 extension zones, termination zones, work more often than would be the case by throwing a dart at the chart. I'll put it that way. And the Dow is back under this key resistance level, so it couldn't break up and over this 496 for a good couple of weeks. It broke down through it today. Now, if we get a move back up tomorrow, it's still over the 21-day EMA, for instance, then okay, all good. And if the Dow is moving up, I think it'll take the others with it. But if the Dow rolls over, then it's possible that we get a period of weakness at index level. Now, I say at index level. Indices have been pretty strong in the last 3 months, sideways for the SPY, down a bit for the Nasdaq, up a bit for the Dow. Individual stocks, as we'll come on to shortly, certainly growth stocks have been hit pretty hard. Now, it's quite possible for some of those stocks to run up whilst the indices run down a bit. And so don't assume that because the indices may be weak, that every single stock in them is also going to be weak, because that's the nature of rotation. Rotation means things can go up within the index and down within the index while the index is doing something completely different. Here's the Nasdaq. Again, nothing burger really. The Nasdaq lost the 8-day today. That's that red line here. So it's not a good look. And is it possible that it hits the 200-day before it finds support at 580? Yeah, definitely possible. So be prepared for some weakness at index level. The VIX volatility index, which is a measure of demand for S&P 500 index puts greater than 30 days expiry, is rising. You see this chart every day on our website if you get the note. And so even if you ignore these spikes, which tend to run up and collapse, the fact is that you've had this rising low since the December lows. Okay, so that means that demand for puts, again, ignore the spikes, ignore these little frenzies. Demand for puts is slowly rising. And I think that's probably in a run up to Q1 options expiry. Okay, let's finally look at bonds. If we use TLT as a proxy, it's an ETF that comprises 20 to 30 year US government bonds. This chart we've been using for many months, and you've seen accumulation down here. Now, you've had all sorts of reasons about why US bonds will sell off, de-dollarization, move away from you know, the US as a safe haven, all of that. But TLT does not support that theory. It's an interesting theory, but it's yet to bear out in fact. And TLT right now starting to catch a bid, as we will see. I suspect that's because inflation numbers, I think, are likely lower than currently reported. This is a really important move in TLT. Here's your post-Liberation Day lows, 1, 2, 3, 4, 5 up. ABC correction, hits the lows down here. If we look at the volume by price, starting to pick up here. That's a weird set of colors, not quite sure around. And let's delete that. Over the 200-day for the last 3 days, right? Shot up over it on Tuesday, tested it from above yesterday, and gapped up over it today. That's looking very strong for bonds for TLT. Bonds up means yields down. Yields down usually means one or two things, either more liquidity coming in or economic weakness. More liquidity, if that's the case, will help risk assets. And you'll see it first in crypto and the other most scary stuff. If it's economic weakness, then you'll see money rotate out of risk assets into bonds. I would say it's too soon yet to see which of those it is. Let's move on and do some single stock stuff. Right, I'm going to do requests first. First thing I want to talk about is XLP, which is a pick in the service. Now, it's up about 11%, something like that at the moment. And I flagged today that if you own this, you might want to think about taking profits. We're going to keep it open as a pick. And this is the reason, which is, you look at this chart, a fairly modest wave 3 extension would take XLP to 94. It's currently 90, so that suggests there's some upside yet. And frankly, a more aggressive take would see it at 106. The things like staples don't tend to get very volatile on the retracements and the extensions. So here, for instance, it sells off down to the 50% retracement. If that was a tech ETF, it would have run down to the 78.6, something like that. And so on the upside, that's also true. You don't often get these 1.618 extensions like you do in the higher growth stuff. So I would say, you know, a very reasonable target is 94, 95 on this. It's close enough where, if I owned it here, I don't, but if I did, I would have sold it today. The chart is vertical. There's sort of extreme rotation into value stocks. Costco has run a lot. So if you own this, you should think about stops or taking some profits or something. We'll keep the pick open for now. Where would you place a stop? You could put it below the 21-day, which is around 84 right now. You could put it below the 8-day, which is at around 87 right now. You have to decide. But just be aware, vertical charts don't stay vertical for very long. Okay, let's move on. Let's get into some of these requests, and then I'll stop in a bit and we'll take some questions. So let's do SOXX software, semiconductor, sorry, which has been incredibly strong of late. Okay, so this is the run up from the Deliberation Day lows. Okay, 1 up, 2 down, 78.6 retrace, 400% wave 3 extension, 38.2 wave 4 retrace. Now look where it is now. It ran into this wave 5 termination zone. And what it did today is it put in a double top, okay, an all-time high. Was it an all-time high? Yeah, an all-time high, which was hit on the 29th of January and retested today, pretty much to the dollar, and then sold off a bit. It's still over the 8-day, it's still over the 21. And so I think it's reasonable to be cautious here. If you've been in semiconductor for this period and you've got some good gains, you should be thinking about stops here, thinking about taking some profits. But so far, this thing keeps running up. And the AI is ruining software narrative only helps hardware. The narrative right now, and I cannot say that word often enough, narrative. Narrative is what you're being preached to, you're being preached at, right? It's a message that you are expected to hear and act on. It may be reality, but it's not necessarily reality. It's a narrative. The narrative says AI is bad for software, AI is great for hardware. So if you didn't know anything, what would you do? You would sell all your software and you'd buy hardware stocks, right? If you didn't know anything. Who is it that drives the narrative? Is it your average retail investor? It is not, right? It is not. It is your large investor. It is folks who own financial media outlets. That's where the narrative comes from. So would it be completely beyond the imagination to believe that whilst you were being told hardware good, software bad, would it be completely ridiculous to suggest that some people maybe were selling hardware and buying software? I don't think that would be ridiculous. And so I don't know what happens to semiconductor tomorrow. I'm long the sector. It could double tomorrow, it could half tomorrow. I don't know, but I do know that that's a double top within a typical wave 5 termination zone. And you might think about how to protect a position up here. A good way to do it without taking too much sort of trigger happy risk is a little bit below the 21 day, right, which is currently at 343. Or give yourself some more slack a bit below this recent low here at 322. You have to decide. There isn't any one answer. You have to decide. But just be careful of narratives. Okay, narratives are not there to help the person being fed the narrative. The narrative is there to help the person who's writing and amplifying the narrative. That's why it's a narrative. Right, next. Software, IGV. Okay, now it's all over for software, as everybody knows. Oh, look, except it isn't. Because look, this is a low, this is a daily chart. This is the low that was put in on the 6th of February, Friday, at 79. And it's now at 80, okay? Actually 81 in post-market. So again, the narrative is AI is terrible for software, great for hardware, sell software, buy hardware. So let me just ask you, right? Down here, is it a good idea? If you knew nothing about anything, would you say sell here? And would you look at semiconductor and say buy here? I don't know, but a lot of people might say that buying low and selling high is a good idea. They could be wrong, but a lot of people would say that. And in rotation, which again is what you have to do if you manage truly large amounts of money, to make money at all, you can't just hope things go up. You have to make things go up. You have to allow things to drop to the bottom of the tank and buy them down there and then talk them up and then sell them at the high. It's perfectly legal. People have done it forever. But you have to buy low and sell high. Sounds stupid, but it's the exact opposite of what the narrative you're being fed at the moment is. So is anyone buying software down here? Well, let's have a look. Oh, look, what a surprise. There's a big spike in volume down here. Now, obviously, for every share sold, there is a share bought. And you could say, well, this is smart people selling and the shares are just being bought by market makers to put into inventory. And of course, that is possibly the case. You can't tell from these charts. I don't know where these color schemes come from. But I would speculate that the heavy narrative of software bad, semiconductor good, at a time when semiconductors are on the moon and software is at the gates of hell, I would speculate that just maybe people are buying software down here, is what I would say. So how would you deal with that? Well, software could obviously keep falling, but you've got a really nice tradable low here. It's great buying down at these lows because you're so close to a low that you can put a stop in place that won't hurt you if it trips. You could say, well, I'll tell you what, if software drops below the Liberation Day lows, obviously something's broken and I want out. So if you had a stop below this 76, you are less than 10% below the spot price. So you're not going to lose more than 10% of your position, but you might get a lot of upside. So I always like buying down here. Why? Because you can use a stop that isn't too damaging. If you're buying up high and your tradable lows a long way away, then stops can be really risky because it can fall a long way before they're triggered. Micron next. Still going up, Micron. Micron's going up because of the A narrative and B reality of shortage of memory of all flavors. I think Micron, for what it's worth, has a bit more upside. I'm not in Micron. This is too scary for me. I couldn't possibly buy here, but the chart says, and I have a feeling the chart will be right. The chart says there's more upside from here. Okay, so based on standard method, 495 to 570, I think is possible in Micron. Where would you place a stop? Well, look, the chart's telling you where to put the stop. The chart is telling you that the support here at 366, and the chart is telling you that if that support breaks, then you could see a lot of downside below there. It could drop to the 50-day at 325. So if you own Micron, you want to protect a position, then the obvious place to put a stop is 365. Absolutely everybody will put a stop at 365. So what I can guarantee is every market maker in the world is going to try and drive the price down to 365, buy all those shares, and then have it reverse back up again. Okay, so don't put it in the obvious place, but it tells you what to aim off of. Okay, where you put the stop, you choose, or don't use one. You choose, your decision. Don't tell anyone where you put the stop. Don't publish it. Don't discuss it. But, you don't need to advertise where your stops are. I don't. You'll see me say that it's a bit below here or a bit above there. The reason I do that is because one of the ways you can make great money as a market maker is to drive at people's stops, take them out and reverse in the other direction. That's forcing people to chase. Okay, so don't help them do that. Next, NVIDIA. Okay, so going nowhere, right? Looks like the Nasdaq. In October, so this is the Nasdaq basically. And what happened recently? Almost hit the 200-day here at 5th February, so a week ago. Bounced. Now it's up and over. It's 200. It's 8-day. It's 50-day, and it's 21 days. It looks quite strong, to be honest. We'll see what happens, but that's a perfectly solid chart. How will you know if it turns bad? It'll start dropping through these short-term moving averages. And how you know it's really bad, it'll drop through the 200. So that's quite a simple setup. Again, what the chart's telling you where support is, it's telling you that support lies in this sort of 170 zip code. And that's also now around the 200-day. So this is a really easy chart to trade. Below 170, bad. Above 170, okay. Above 185, good. It's really simple. Sometimes charts make it easy for you. Sometimes they're really difficult. But this one, that's easy. Why is it easy? Because you can control your risk. Okay, so if you set a stop somewhere below the 200-day, you can't lose that much from here. So how bad can it be? Right, let's do one more and then let's stop for some questions. Let's do Taiwan Semi and I'll come back to Google after that. So Taiwan Semi. You saw us, I think, what this is. Is that a real price? Did that actually happen today? That looks like a, no, didn't think it did. Okay. Okay, so Taiwan Semi looks like it's approaching a 5th wave high to me. Let's go back onto the daily. Right, so ignore this. That's not a real price. It's been a bit of this recently in TradingView and TrendSpider. It's exchange data problems. This is a daily chart. Let's see where that wave 5 termination zone should lie. Remember, what's the narrative? AI, bad for software, great for hardware. So that's obviously brilliant for Taiwan Semiconductor. Right? That's the narrative. Okay, there's a wave 4 low there. So this stock is smack bang in the middle of typical wave 5 termination zone. Doesn't mean it's going to stop here, could double tomorrow. But as it happens, that's where it is. If I own Taiwan Semiconductor and I don't, I will be selling it now. Okay. Again, where he stops. See, the trouble with charts like this is logical stops are quite a long way down because the 8-day is at 350 and the stock's currently at 368. 21-day is at 341. 50-day at 3. You see what I mean? It could fall a long way before your stop is tripped. So it's much more difficult to protect yourself up here. Let's stop for questions. I think we got mics on. Yes, we do. So if anyone has anything on anything we've covered so far, or frankly, anything we haven't covered so far, have at it. So either shout in the system or you can post questions in the Q&A or the comments functionality here. If we don't have anything, then I shall press on. Richard, you're on.
Thanks, Alex. Just back to that SOX chart.
Yeah.
I'm wondering whether the dip and then the subsequent high, as you mentioned, do you think that could be a kind of a smaller degree wave 5? So I know you've got your larger degree wave 5 there. Is that right in your opinion? Do you therefore think that your wave 5 kind of terminates there, or should it terminate a little bit further to the right? I'm just thinking like you were pretty close to the top.
Yeah. Okay. So just to illustrate what Richard means, what he means is this. So in this, so within a wave 5, it'll be broken down within another 5 waves. Okay, so this is what Richard means. He means, is that a 1, a 2, a 3, a 4, and a 5? In which case, right, there's a bit further to go. That's Richard's point. Yeah, it could be, couldn't it? I mean, that would make sense. And also, if there was a bit further to go, it doesn't break this. I mean, there's nothing, as we all know, there's nothing scientific or religious about these patterns, but they do work. I like these wave 5 termination zones. They keep you safe. They work more often than not. Sometimes you sell a bit early, but they tend to mean you don't, hold in the expectation of things going to the moon when they don't. So could that run up a bit further? Yeah, it could, couldn't it? So let's measure it, right? So let's say that's true. Let's say that's a wave 4 low. We're in a wave 5, but we think there's a wave 5 R5 still playing out. Where would it end? It would be as your wave 3 high, low. Okay, so that would end somewhere between 376 and 405. So yeah, could be, definitely could be. Double top's a bit of a concern because the alternate view, to state the obvious, would be, look, semiconductor already topped, but this is a way for late sellers to get out. And actually, where we're in is this, and a B, and we're going to guess it is the alternative view. So I don't know, obviously, but yeah, it definitely could have more upside. How would you solve for that? Well, tight stop below the 8-day, or tight stop below the 21-day. What's that? 340. So that's only $15 away from here on a 351. I'm sorry, 11. Yeah, it's up in post market. 350, $15 away on a 355 stock gets you a stop below the 21-day. So if this is an ABC, it will take you out before the C leg really craters. And if we're in a final 5th wave of the 5th wave up, then you'll get the upside. So yeah, good point, Richard. Yeah, well made. Thank you.
Yeah, no, I'm like you. I'm a little concerned that we are much closer to the top than we were to the bottom, so to speak.
Yeah.
So it's exactly the same. It's where's the timing? Where's the, how far do we fray the nerves to wait until it tops? And then do you think that we would see a pretty significant fall after that when it does complete?
Yeah,
and what
I
could
do,
it take
because
it down to?
okay, you asked me what I really think, okay, and of course I could be flat wrong. What I really think is there's going to be a big move back into software. That's what I really think, because I mean it's ridiculous. Everywhere you look, people are telling you that it's all over for software, and if you sit with Claudebot for 3 hours, you can rewrite the whole of SAP, Oracle, Microsoft Enterprise applications, and your email server it can do on a Saturday lunchtime, and which is obviously total nonsense. It's complete and utter garbage. Is AI, bad news for traditionally employed software developers? Yeah, of course it is. Are people going to rip out their enterprise applications tomorrow? No. Are the terminal valuations, to the extent that's a thing, of enterprise software value companies going to be lower? Yeah. Are the growth rates of these companies going to be lower? Yeah. But are their margins going to go up? Probably, yeah, because they'll be firing their own developers. So I don't buy that if you run a Mac Mini with a VPN, you suddenly don't need Oracle. And it's just nonsense. Okay, it's a nonsense narrative, and it comes at a time where you're being told to sell software, which is on the floor, and buy hardware, which is on the moon. So I don't buy it. So what do I think? I think that if I ran a big pool of capital, and I've been in semiconductors for last year, I'd be taking some profits here. Right? I'd be having stops in place. I'd be buying some puts. I'd be taking some gains, and I would be building up, and I'd be slowly accumulating in software. I wouldn't YOLO. I wouldn't go and pile into Microsoft today, but I'd be buying some. And when we get to the software charts in a moment, you'll see that I think that's exactly what's happening. So what I really think is, yes, semiconductors approaching a local high, not an all-time high. There's a lot more memory to be sold. There's a lot more GPU to be sold. There's a lot more CPU to be sold. There's a lot more power management to be sold, optics, all this, but a local high. That's what I think. That's what I really think. Could be wrong, but that's what I think. So everyone knows I'm long SMH. I'm long it because one of our algos has that long at the moment. I have a pretty sizable allocation to it. So I'm long it, but I'm expecting the algo to flip out of that before too long. Okay, so that's my personal position. Okay, great question, Richard. Thank you. Anyone else have anything else before we move on? Ron, you're on. Ron Demons. I can't hear you, Ron. Can you? trying to mute.
How about now?
Yeah, great, perfect.
Okay. Yeah, you mentioned. I'm just curious about the mechanism by which a market maker or somebody who's running a large pool of capital would sort of flush out trailing stops, or that what I would think of as trailing stops, like flush out those lower positions, and then things would drive higher. I don't understand sort of the mechanics of that. Is there a simple layman's explanation for that?
Yeah, you know that great meme. You know, the secret ingredient is crime. Right, that. um, it, some types of stop orders are visible at exchange level. Some types of stop orders are visible within your broker, but most brokers, the big brokers, have internal pools of capital. So now I use Interactive Brokers. A lot of stuff will be traded just within their liquidity pools, and so if you can see, and if you talk to anyone that's worked in, in a market maker in the old days where people used to write tickets and post them on the board, it wasn't that long ago, they'll tell you, right, that, what if you've got a resting sell order, or frankly, if you go and buy Bookmap, a software service, you'll see where all the resting orders are. So you'll see where people's sell stop limits are, buy stop limits are, and if you have enough liquidity, then you can't drive a stock from 50 to 100, but can you drive from 50 to 47 by, buying puts to force dealers to hedge to move the price a bit? Sure, you can. There's all manner of dark arts that people can use. Now, again, can you move a stock by 100%? No, of course you can't. But can you move it by a few points? Yeah, sure you can. And
so if you're using trailing stops, are we collectively, I don't mean the people on this call, but just is the market collectively signaling to a relatively few people who have more visibility into things than we do, kind of where sort of the ledges and the cliffs are?
Yes, yes, and you can look at this with so-called order flow analysis. There's lots of ways to do this. Most broker platforms will give you so-called level 2 data, which is the actual orders. In my experience, it's very difficult to read unless you're an expert at it. But there are things like Bookmap and other software applications that will give you it in a visual way, where you get a good sense of the distribution of actual orders. One of the reasons I use volume by price so much is that's a kind of, it's a sort of a historic order flow analysis. Or when people use the word order flow, they mean real time. I mean, what does the order book look like today? Where are the sell orders? Where are the buy orders? What size are they in? Okay. And Bookmap and things will help you see that. I don't use it because I can't fit it into my daily workflow. I'm just too busy. But if I was purely trading as opposed to also running this business, I would definitely have a screen showing me the order flow map, the real-time order flow map of any stock or future that I was interested in. So yeah, you if you put a stop order in, a buy stop or a sell stop, you're putting a target up for people to shoot at. And so the great thing about stops is, if you get busy, they'll keep you safe, and they'll take you out where you want to be taken out. The bad thing about stops is you're advertising where you're prepared to sell or buy. And so if you were a robot and you could keep all these things in your head and not second guess yourself and not get emotional about it and never leave your screen, you would never put a stop order in place. You would just have a series of things written down on your notebook that when the price hit that, you take the action you planned. If you're human, what happens is you go, well, maybe that, no, I don't know about that. Maybe something different's going to happen. Or you go off to make a cup of coffee, or, walk the dog and something happens and then you've missed your chance. So stop orders are there to solve for emotion and for life, but they're not a great thing to do compared to perfect trading. Perfect trading would just you have your plan, you write it down, you execute it when the situation happens. But most of us don't have lives and brains like that.
So a trailing stop can, in aggregate across millions and millions of buyers and sellers, it sort of can become its own reality.
Yeah, of course. Yeah. No, absolutely. I mean, if you look at order flow analysis, stops absolutely become their own reality. They're magnets. It's the same way that it's an analogous way to how options drive stock prices. In theory, options are derivatives of stock prices. In reality, very often stocks are derivatives of options, because the hedging flows that happen as a result of people buying and selling options mean that You know, if tomorrow somebody goes and buys a wall of call options in SOX, SOX is going to go up. Why? Because the market makers have sold the options. Okay, so somebody's bought a call, market maker sells the option, so they've gone short SOX. Market maker makes money not by directional exposure, but on the spread. They need to hedge their book. If they've sold a call option, they've gone short. They have to buy the underlying to hedge out. And so the simple act of buying enough call options in SOX will drive SOX up. You know, these systems are not complex, but they're multi-level with multiple, if you like, reflexive inputs on themselves, which is why, you know, trying to buy an ETF or a stock based on its fundamental valuation is, you know, nonsense. You have to buy these things based on price reaction to the previous price, volume that's going on right at the moment. And again, if you're a professional trader of the S&P, then your primary screen you would see in front of you would be the order book. That's what you would watch, because then you're looking at where everybody's orders are. If you get a chance, if you haven't read it, there's a great book, and it's in audiobook form as well, called, I can't remember, I think it's called Flash Crash. I'll post a note on it, and it's a story from it's a bit about high frequency trading. It's a bit about one trader that basically had the end of the world pinned on him, but it does a very, very good job in very simple terms of describing the use of the order book to trade off. So I'll post it in chat later on. So if this is all new concepts to anybody, it's a really good introduction to it.
Super, thank you.
Great question, Ron. Thank you. Paloma, I think you had a question lined up.
Yeah, hi Alex, how are you?
Good, thank you. How are you doing?
Very good, thank you. I just wanted to ask you, this is a bit of a conceptual question, value versus growth, because I got stopped out of 85% of my portfolio last week.
Yep.
So I have like 3 stocks left,
yep.
which actually I feel very relieved because I have cash.
Because now you have cash, yeah, exactly.
So
that's good.
I have cash. I don't know what to do with it, but it's just sitting in my bank account for the time being, and I'm not very concerned. So I'm just happy.
Yep.
The problem is I got stopped out with minus 10%. That's not a biggie.
Yeah, that's a high quality problem, though, isn't it?
Exactly. But I'm seriously thinking of going into value. In general, I mean, global value, not only tech value, you know, first global, because I think that, you know, we can't just be invested in the US. Well, that's my personal view. And second value, because, you know, I've been watching different ETFs and different value stocks, and they actually make me feel very comfortable in the current market environment. I don't know if you have a view of value versus growth right now.
Yeah, SCHD is a great value ETF.
I own it.
You do, yeah. It's a great thing to own. It's a really great thing to own. So it's a great. We just compare these two right now. Let's look at total return, including dividends. Okay, so this is, hopefully people can see it. So this is SCHD versus SPY. So if you do the 10-year, then you'll see that SPY, which is the orange line, outperforms SCHD, which you'd expect. You know, over a long enough time, growth is always going to outperform value over a long enough time. If you look at the maximum available time, yeah, it's so 633 versus 500%, so it outperforms materially. But obviously, there will be periods in time where that's not true. So let's start to look at some smaller time frames. Okay, last 3 years, SPY is up 76%, SCHD 38%. So clearly, growth over the last 3 years has been preferable. Last 12 months, pretty close, right? In fact, value just edged it out. So over the last 12 months, if you think back a year, around now is when the market started to fall. And it cratered into April with Liberation Day, as we know, but it started to falter around here. I remember our our risk on, risk off algos went risk off right around now last year. And so look, since in the last 12 months, SCHD 18 points versus SPY 16 points. So value has outperformed growth in the last 12 months. Let's put QQQ in here as well, actually, for completeness. There you go. So SCHD, boring dividend ETF on a total return basis, including dividends, has beaten the NASDAQ and the S&P in the last 12 months. Now let's look at the last 6 months. Killed it, right? 20% up in value, 9%, and the NASDAQ 7%. Last 3 months.
No, I'm
18.
Yeah, I'm super happy with the ETF. I'm really
no, it's a really lovely thing to own. It's a really great thing to own. And so the question, of course, is, you know, where is it? And so why don't we look at the thing itself? So what we know is value is doing well. So let's have a look. And also, I mean, look at 2022, right? So if you remember the S&P from, you probably don't remember, but I don't have any hobbies, so I remember. This is what the S&P did from the COVID lows to the 2021 high to the bear market lows. It dropped 50% in the S&P of the value that it created from the COVID low to the 2021 high. And the NASDAQ dropped 62%. And let's look at what SCHD did. It's a much less volatile thing. It drops, it'll be about 38.2. Yeah. Aha, look at that. Perfect. I definitely need to get out more. There you go. So in the bear market, you lost really not very much in SCHD, and this is price. This doesn't include dividends, this chart. So in actual fact, on a total return basis, it was a bit better than this. So where is it now? Well, it's in a wave 3 up. Generally with these things, you don't get, you know, an explosive wave 3 up. You don't get the downsides. You don't get as much upside, but you probably get 100% is my guess. So let's see where it could get to.
I really love this ETF.
Yeah, me too. No, it's terrific. Yeah, I agree completely. We are developing an institutional algo strategy with this in it. Right. So my guess is conservatively this could get to, you know, 36 from the current 31, and that's pretty cautious. You know, I mean, it's very possible that it goes higher, but I would say on a cautious basis that could get to 36, which is what, 20-ish, 17, 18, maybe 20% from here. And you know that it's not going to dump too much either. Could we see, it's been vertical lately, so could you see a short-term drop off in favor of SPY? Yeah, I think you could. But look, you 200's turning up, everything's turning up, and you are not really near even a shallow wave 3 high. So yeah, I think it's a good thing to own. And also, look, what's the worst thing that can happen if you're wrong? It doesn't go down that much. And so let's say that you put money into this and all of a sudden, you know, growth turns on. Well, this won't go to zero. It'll just drop a bit. But meanwhile, you're getting paid to own it. So yes, it's a really nice ETF. Yeah, really good.
Great. Okay, so I'm happy with it. I don't own a lot of things, but I do own this guy, and I'm very comfortable. Very comfortable. It lets me sleep at night.
Exactly. Yeah, exactly. I mean, the other thing is you know, look, from inception, it's only up, right? It hasn't really done anything scary, you know. So this is a weekly chart going back to 2012. It you know, it dumped into COVID like everything else, but it came out of it pretty quickly. It was back to the February high by August 2020, and it's been only up since then. So if you owned only this all the way to the 2022 bear market, and again, remember, this is a price only chart. If you include dividends, let's just go back a bit. What did it do in 2022? Yeah, so in 2022, it peaked coming in at 37. It dropped to, yeah, 33. Yes, that'd be a pretty relaxing thing to own, right?
Yeah.
But yeah, it's a good one.
Okay.
All right, good call. All right, great. Let's keep going. Right, what have we got next? Next up, we have, okay, let's do Google, and I'm going to apply through some of these other names. Okay, now, the theme you're going to see from me now is I think growth is going to come back into fashion. That does not mean I think that everyone's going to pile into it tomorrow. Possibly this is a Q2 artifact. Why do I say that? Because very often sector rotation happens on a quarterly basis, and that has to do with quarterly options expiration. So it could be that after the March expiration, which will be the middle of the third week of March, I forget the exact date, you might see growth start to move up after that. But if you look at a lot of these growth stock and ETF charts, they look like they're bottoming out to me. Again, I'm not saying the bottom. I'm not saying pile in. I'm not saying buy with both hands. I'm saying don't buy the narrative of growth is dead forever. Right, so let's just step through a few of these. Let's start with Google. Now, Google, funny enough, does not look like Microsoft and everything else because, of course, it is played AI so far really, really, really well. So Google, the chart looks different, I would say, and quite possibly, you know, that's a local high. Certainly, it's dropped. This is a wiki chart. It's dropped down through a couple of short-term moving averages. Can anyone who's not on mute go on mute, please? So it's dropped down through the short-term moving averages below the 50-day now. So I'd say there's some downside in Google, and I would be really careful if I owned Google up here. Let's just look at the volume profile. Those annoying colors again. Woof. Okay. I mean, that looks like distribution, right? That looks like accumulation down here, distribution up there. So I'd be a bit careful with Google. Next, time and semiconductor we're done. Let's do ARM. Okay, now why I think ARM is interesting, and this is a thesis, so you have to be very careful with theses. They're dangerous. You know, you just always follow price in that thesis. This is why I'm interested in ARM, because I believe strongly that the current AI model just can't work. Okay, you just what is the problem here? The problem is too much matrix algebra. There are too many tokens generated per query by each of these LLMs. Okay, so anytime you ask it a question, even a relatively simple question, the sheer amount of heat and light, literally, that has to be generated by these things to answer the question, it just can't last. It is like you're asking in the old days, you know, a mainframe to run the accounts. And so in the old days, you submitted a batch processing job to mainframes. You said close the monthly accounts, and then you went home, came back the next day. Maybe they were closed, maybe they weren't, maybe it took another 2 days. You know, and we're there a bit now. You ask any of these LLMs a relatively complicated thing to do, and they churn away for quite some time. Okay. Meanwhile, they are eating memory, eating GPU, and eating power. Okay. And that can't last. It's too expensive, and something has to change. So what's going to change? Number one, there are already different LLMs coming out that break down tasks and deal with them in smaller, discrete chunks. There's going to be another generation of LLMs, I think, which have just a fundamentally different architecture and are much more efficient in the way they process things. And then you won't need as much memory. You won't need as heavy compute. People will probably still use GPU for the training side, but on the inference, which is the generative side, it's when the questions are being answered, when the images and the videos are being generated, I think you can do that with less power. And I think the number one beneficiary of this in semiconductor is going to be ARM. You've seen me say this a lot. I think the chart is bearing this out now. The stock, this is the Liberation Day lows here, 79 down here, 1, 2, 3, 4, 5 waves up here, ABC correction, then an all-time high, I think, at 182. Was it? Double top, not quite a double top, and then a big correction down to 102. And then you've seen it hold support around here and start to move up. So right now, the results they printed just this quarter were fine. They were okay. They didn't justify that. But very often, as you've heard me say a lot, you'll see prices respond much faster than fundamentals. Nvidia in 22, 23 started jumping up way before the fundamentals showed it. Why? Because people do fact checks, supply chain checks, customer checks on what's going on, what the orders look like, all of that, way before it appears in the 10Qs. So I wonder if we're seeing the same thing with ARM here, but you see it, rocket up over the 8, over the 21, over the 50, and that's going to come down in a wave 2 now. But as long as that holds over, say, 100, I think this is in good shape. And if we look at the volume profile, I'll change these colors later. Look, I don't think that's selling down here. I mean, really, would you be selling down here if you could have sold up here? I don't think so. I think this is accumulation. So I think ARM's in good shape. I own it. I've been adding to it. I've got a stop on it somewhere down here. I can't remember exactly where, but I have a stop on it just in case it all goes to hell. But I don't think it's going to go to hell. I think that's in good shape.
Where is the stop, Alex?
I'm not telling you where my stop is. You can see where the stop should go, right?
Okay.
This is right. I keep saying, do not advertise your stops. Don't talk about them on this call. Don't publish them. Don't write them down in emails. You're just making it easier for people to take the money off you. But you can see where the stop should go, right? Okay. You can either set it off of the most recent lows, or you can set it off of the short-term moving averages. You've got to decide how much risk you want to take.
Okay, good.
If you read my post, right, I'll always post when I place a stop, and I'll tell you roughly where the stop is. I'm just not going to tell you the exact price, okay? But you can work out from what I post roughly where the stop is, and that's always what I think.
But is the rule of minus 15% does that make sense? Because
I never use that rule. That's my start point is how much am I prepared to lose? Right? How much money am I prepared to lose? That depends on how big of a position is it, how much upside do I think there is, how am I feeling about life in general, all that stuff, right? And I like buying stocks in places down here because you've got a really obvious low here, so there's a 100, 101, 102, which is a really obvious low that's been defended. And the way I think about it is if it drops below that, something bad has happened, right? The thesis has changed, the world has changed, something bad happened. And so if something bad has happened, you probably want out. That's how I think about these things. And the other thing is if you look at, I haven't done this, but I bet you that's a standard retracement. Yeah, there you go. Haha, look at that. I really have to get out more. Okay, look. 78.6 retrace of the move up from Liberation Day lows to that high down to here. Okay, that's a wave 1. That's a wave 2. It's under accumulation. I think that thing is going up. Where would you put your stop? Somewhere below here. Worst case, if it breaks the 886, something very bad has happened. And if it drops through Liberation Day lows, something terrible has happened. Right? There's your logic for stops.
Okay, sounds good.
Great. Right, next. You're welcome. Microsoft. It's all over Microsoft, as everybody knows. Oh, except it isn't. Okay, I own Microsoft. I'm a bit underwater, but not much. Okay. Right. So, Liberation Day lows, 1, 2, 3 up. And I think, I could be wrong, I think we've got a 5th wave up to come. Now, that's an extreme view. Why? Because that's a very deep wave 4 correction and it only just held over that wave 1. Okay, another view would be something like, I don't know, that was a 1, 2, 3, 4, 5, and then an ABC correction. We're starting a new wave 1 up. But if so, then that's still a bullish setup because this would be a small wave 1, that would be a 2, and away we go. Microsoft, I think, found support down here at around 391-ish. On a day like today, it was a pretty rough day in the indices today. Microsoft was down 0.6%, and the Nasdaq was down 1 point something or other. Wow, 2% drop in the Qs today. Microsoft less than that. So that tells you it's holding up better than the index right now. So I think Microsoft is on the ups. We'll see. I would say that volume profile isn't. Yeah, I think that's a start of some buying down here. I don't think that's not like a grab it with both hands sort of profile, but I think that's the start of it. So I think Microsoft's in good shape. Let's do Meta. Okay, Meta. Yeah, that chart's broken. Okay. Think, yeah, no, I'm happy with a lot with that overall. Okay, so Liberation Day lows, 1 up, 2 down, 300% wave 3, deep wave 4, holds over the wave 1 high. I think we're in a wave 5 up. So I think that can hit 800 on a run. So it got hit pretty hard today. But you're still in an uptrend from these lows in November. It's doing better than the Nasdaq since November. So I don't own this one. I don't much care for Meta, but I think that's okay. I think that can run up, I guess. Amazon. I published a note on the free side of Seeking Alpha on Amazon today. I'll circulate it later. That I think is holding. Yeah, look, that's not bad volume down here. So Liberation Day lows, wave flight. See what I mean about these termination zones? They're not perfect, but they work a lot. Okay, so whenever you see me post one of these, obviously there is no science or certainty to it. It's just a rule of thumb, but they work more than one would expect. So take notice of them. You can ignore them. You don't have to act on them, but they're not a bad guide. So just be aware if the stock you own is in or approaching one of these termination zones, just have a think about it. I mean, if all you do is think about it and ignore it, that's fine. But think about it, because they're pretty good ways of controlling risk and not getting rugged, basically. So it hits this high, 259 back in October, ABC correction down here, puts in a new low today, but came back up intraday. So 197 intraday. Numbers were fine. In fact, if you give me a second, I'll get the numbers up. One second. Let's switch sharing up for a minute. We're way over time, by the way. Okay, so. Okay, so Amazon fundamentals, hopefully you can see that. So this is the quarter, December just printed. Growth accelerated, 13.6% growth in the quarter versus 13.4, 13.3, 9 previously, 12.5% on TTM basis. Next quarter's guide is for a slight slowdown on a quarterly basis, but the TTM still grinds up because of that flywheel effect. Cash flow margins are low, 2%. But they always were, to be honest. I mean, it had a little peak, here in 24. But if you look historically at Amazon's cash flow margins, it's never really made much money. They've always chosen to run at low margins to invest in growth. And so nothing really has changed there. $57 billion of net cash in the balance sheet. What did the stock close at today? 99 something. It's less than 3 times revenue. And then the thing that caught my eye about Amazon, I'll share the article, is it's not expensive versus its own history. Okay, so often it's helpful to look at where a stock has traded on its various multiples for its life. And so that takes account of course, all different cycles of the market, fashions, whatnot. It's not expensive versus its own history. So I think Amazon is not in a bad place. I love the company. I don't think the CEO is very good personally. But on the chart, on the numbers, I don't think it's a bad place. And again, if you want to buy a position now, well, you've got a really, easy trade, which is you've got a recent low to trade against. Now, again, against that, it's below the 200-day. And so a prudent investor would say, well, I'll tell you what, the 200 days, 10% over here, I'll wait, because there's a certain just relentless selling logic when stocks are below the 200-day for no reason other than, that's what systems are programmed to do. And you can see that when stocks touch the 200-day from above, they very often hold over it. This broke hard. And so a more prudent thing to do, I guess, would be wait, see if it gets over the 200-day, buy over the 200 and put a stop below the 200 would be a more prudent thing to do with Amazon. Right, Salesforce. Right, I'm going to try and run through these now because we're running late. Salesforce. I really don't like this company. I think the customer service is terrible. They're cynical, gone ex growth in their mentality. But if you put we're a customer and their hard work, but if you put all of that aside and just look at the actual stock, here's the bear market lows. December 22, the stock bottomed out at 126. It got absolutely hammered in 2022. It dropped from a high of 312 to a low of 122. I'm sorry. It and Meta were hit harder than anything else in amongst the bigger companies. Where is the stock now? We'll take the bear market low, the recent all-time high, and it's at that nearly at that magic 78.6 retrace there. Look, so I don't like this one. I'm not going to be buying this personally, but just on a chart, yeah, you got some volume picking up down here. So again, I wouldn't grab that with both hands yet, but I would watch that volume profile. And if this holds over 177, and at an absolute last stand 153, and you see the volume picking up here, then that's probably going to see some accumulation, is my guess. Right, TTD. This kills me. I have TTD. I don't buy options very often, but I have this in options, and there's so much I wish I didn't. And I should have got rid of it, but I didn't. I broke all my own rules. But anyway, where is it? So hard support at 40, blasted through and broken. Let's see where it is now. So if we go from the IPO price, okay, so it's dropped below the 78.6. Let's see what's happening with volume. Yeah, could you say that that's under accumulation? Not yet, I would say. There's a bit of interest here, and that's because the stock hit the 61.8 retrace. These things are not magic. They sort of just rules people trade to. Two ways you could argue this. You could say, well, there's volumes falling off down here, and therefore there's not many sellers. But you don't see what you want to see to buy stocks like this. Is you want to see a big chunky bar down at these key Fibonacci retraces. So you want to see a bar like that, and when you see that, you think, okay, that's accumulation. You can probably start buying at that point. I'm not sure TTD is there yet, unfortunately. Apple. I sold this for a nice small gain recently. You saw the disclosure. It's still a pick in the service, and the reason it's still a pick in the service is because I think this chart is still good. So I think Apple's going to 302, maybe 337. Liberation Day lows 2.236, probably way three up. Bit more than the 38.2 retrace, and there's nothing in this chart that says that's not in a way 5 up. So I think it's got a shot to get into 300. I sold it already because I was just in it for a short-term trade, but I think that can run up. So I feel okay on Apple. The narrative at the moment is they've got these great new AI devices coming out, which will be able to handle lots of AI calculations on the client side. The narrative goes, oh, well, there isn't any memory, so they won't work. And that's the narrative to get you to sell the stock. But we'll see. Broadcom. Yeah, okay. I think that's a righteous chart still. Broadcom, I think, can go up even if NVIDIA is falling, by the way. Yeah, I think that's a righteous chart. So I'm going to say Broadcom can make it to 434. Broadcom is, along with ARM, a big supplier of bits and pieces to people who are building their own inference chips, so Google amongst others. So the move to lower power, more efficient AI processing will benefit Broadcom, it will benefit ARM. It will be neutral, maybe slightly negative for NVIDIA. I wouldn't bet on NVIDIA falling off anytime soon, but I would say watch ARM, watch Broadcom. Broadcom is dragged down by, there's a lot of its business that's sort of old line enterprise software, but in chips, it's going to see more and more demand for inference-driven chips, I think. Lastly, Palo Alto Networks.
Alex?
Yeah.
ARM or Broadcom? Which one?
For me, ARM.
Okay.
For me, ARM. because of where the chart is, and because I have that most dangerous of things, a thesis, right? But that's just my opinion. The safer play is Broadcom, because that's a market leading thing. There's more money in it. You've got a wave 4 low there to trade off. That's a safer play. But for me, if I look at I look back and I look and I go, this AI model cannot work. It just can't work. It's ridiculous where people are going, I've got to bus in, you know, enormous, great localized power supplies and generators and hydrogen cells and nuclear, but this, God knows, it's ridiculous. It's preposterous. It can't last. And when you see situations in tech where, you know, it just doesn't work, what happens is some bright spark comes along and goes, I tell you what, I'll give you the Valley Law, LORE, is 10x the performance at 10x less the price. But in fact, what you normally get is performance is good enough for a lot less money. Okay, and you're going to see that in AI. It's absolutely inevitable in my view. It's written on the wall. And so that, to me, will benefit ARM disproportionately. But that's a thesis. The safer play is Broadcom, because it's a big market-leading stock, because you've got some stability from the recurring revenue in the enterprise software. You've got a really aggressive CEO who's very good at what he does, and you know, and that chart is a bullish chart with a close buy support. That's the safer play. But I sort of think ARM might be a big winner here, so I fancy ARM. That's my answer.
Thank you.
Great question, thank you. Right, Palo Alto Networks. I bought into this recently, small position, and this is why I bought into it, because look, it's all over, right? It's all over because AI is going to rewrite cybersecurity, and you don't need these players anymore. Get Claude Bot on a Raspberry Pi and a Cloudflare connection, and you can invent your own enterprise-grade security system. I don't think so. So here's Liberation Day lows, 1, 2, 3, 4, 5 waves up, ABC correction, bottoms out here at 151, now at 162. That looks like a 1 and a 2 to me. And if we look at the volume, that's pretty good to me. I think we're seeing some accumulation down there. That's the sort of bar you want to see. That's what you're looking for. Okay, that sort of thing. So again, what would you do if you bought into this? You've got a tradable low at 151, set a stop somewhere below that. You're currently at 162, not very much downside, and you could see this run to the upside. One thing in Palo Alto Networks' benefit is it's basically a hardware company that pretends to be a software company. And the old paradigm, I would say that's bad. But with this narrative that says software bad, hardware good, then actually this can do two things. It's sold off as if it was software, but they have a counter narrative that says no, this is all in custom hardware and ASICs and whatnot. And oh, by the way, we run software over those ASICs, but no, this is a hardware play. Is their counter narrative? I like Palo Alto Networks at this point. I bought into it recently, just a 1 unit position. You saw the disclosure, and I put a stop on it as well. And you saw the disclosure of that. So I think this one could do well. Now, we've pretty much talked about this rotation back to growth, but I just want to highlight it with a couple of stocks that one stock in particular that we don't cover, but there's gotten a lot of publicity for it's all over recently. This is ServiceNow. This is, run by, Ellison Acolyte. There's nothing particularly like about the business in my view. But look, it's been written off. Everyone says it's all over, blah, blah, blah. But here's the bear market low at 66. It runs up to 240, which it puts in January this year. It's dumped it's dumped 80% of the value it built up from the bear market low to the January high. Okay, so this is what pain looks like in software. But oh, by the way, let's just have a little look at the volume. Okay, that is what you're looking for. That's just starting to pick up down here. And today, ServiceNow was up 2.68%. The Nasdaq, I'll remind you, was down 2%, and this was up 2.68%. That could be an accident. It could just be short covering, but I don't think so. I think we're going to see this run up. I might buy into this. There's nothing I like about the business, particularly it's run by one of these old guys who, just follows the Ellison playbook and probably we're retiring soon. But that's a nice looking chart if you ask me. Tradable low, volume picking up, and the narrative could not be more negative. Zscaler, same story. Liberation Day lows at 165, which it just revisited, 163.45 waves up, 336 in November, 164 now, so it's basically halved since November. Why? Because if you've got an old Commodore Amiga, you can fit it with some memory if you can find any, and write your own cybersecurity software. But look, this is retraced all the way back down to the Liberation Day lows. And so the volume. Oh, now that's what you're looking for, okay? If you really think that's institution selling, I've got some TTD options to sell. That looks like accumulation to me. And again, today it was flat, down 0.06% on a day when the Nasdaq was down 2%. So I think that is going to start to get a bid. And the last one I'll leave you with is what for the moment is a terrible pick in service ETHA, but I think will work out. And let's look at how this is doing. This is the BlackRock Ether ETF. It's all over crypto, as everybody knows. Liberation Day lows. $11 runs up to 36. We're now at the 88.6 retrace. That's pretty deep. You don't really want to see it drop below that, but it hit support there. And let's look at volume. Starting to pick up. And you know, on a day where really you should have seen crypto absolutely dump today. Native Ether is down 0.6%. Bitcoin 1.7%, Ripple 0.9%. Bitmine Immersion up 1.4%. So Nasdaq down 2%. You should be seeing crypto down multiples of that, and you're not. So I think ETHA, I think might be bottoming out. So my thesis here is I think we're going to see growth start to get bought up. Not tomorrow, could be some weakness still. I would look at maybe Q2 for this stuff to really start to take off. I would not abandon value. We looked at the SCHD ETF. It's a really nice thing to own, as Paloma says. A relaxing thing. You can sleep at night, pays your dividend, doesn't go down much in the bear market. Nothing wrong with that. But don't write off growth. In particular, don't write off software. I suspect a narrative has done its job. People have sold their software stocks, and I think they're going to be surprised when these things start to drift up over the course of the next 2 or 3 quarters, would be my guess. Okay, we've got time for a couple of last questions, and we're 15 minutes over, so we have to finish. Actually, I think we're done.
Alex, do you really think we still have hope for Ether? Because I am so underwater that it's so unbelievable.
I do. Yeah, me too. But yeah, I do. I think you've got the New York Stock Exchange, you've got JP Morgan, you've got the CME, you've got all sorts running financial infrastructure on this, and yes, I do. And I think there's a big washout in crypto for the moment. I can give you all sorts of my own conspiracy theories as to why that is. Not least Epstein fallout. But yeah, I mean, this is Ether is transaction processing tokens on the new financial settlement infrastructure, which is the Ethereum backbone. So yeah, I do. I think this is going to be good. But you know, yeah, I'm underwater as well. So it comes down to allocation side.
Okay, thank you.
Okay, folks, we better finish up. Thank you for attending. Thanks for being members of the service. Anything I didn't get to, hit me up in chat later on. We covered a lot in the webinar today. So if any of this is new to you, or you were like, wait, what was that? I didn't understand that, or I don't agree with that, then reach out in chat. Use chat. We don't use it really enough in the service, so use chat. Thanks a lot, everyone. Talk to you all soon. Video live in a couple of hours.